turning points in history like 9/11 or December 7th, Pearl Harbor, or Kennedy's assassination. These are things people remember. But what we're seeing is a much more gradual, slow turning point, and we're living in it right now. It's not as obvious as the Kennedy assassination or as obvious as Pearl Harbor. And without being dramatic, I think we're in a moment that's really crisis moment. And that sounds sensational, I get it. But those things are interesting to me, the slow drip of history versus one event. And we're seeing the slow death of US dominance. We're seeing the slow death of trust. So that's a theme, just trust and desperation. Mm-hmm. But yeah, bond markets, my God, Sigma moves, it's insane. These mathematical signals and the technical signals behind precious metals are extraordinary too. But it's just a reflection, I think, to compare this move we're having now, post 2022, to where we saw gold go after 71 to 80. That was a bull market after the decoupling from gold and these things. But what we're seeing now is a very different type of bull market because it's a very different type of global setting. It's even more dangerously high. In a sense, like I'm not even that excited about it as a gold owner because what it really signals is unpredictable but very significant change. And I always use the Stalingrad metaphor because when an army is losing, even though they've clearly lost the war, they will fight and there will be more casualties. I think we're in a Stalingrad moment right now. In the US history, that's Gettysburg, the army had lost, the South had lost, but they fought for 2 more years and there were tens of thousands of more casualties. And so I think we've lost. The US dollar has lost as its global reserve status. It may have it officially, but as a reserve currency, it's gone.
Welcome to the Microscopic Podcast presented by Gold Republic. My name is Alexei Joranov, and in this format, I invite you to look at the world through different lenses, to see what's hidden in plain sight. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. Great to have Matthew again here sitting next to me in our office, our newly built office here in Amsterdam. So the last time we saw each other was in Zurich.
Yep.
And the time before was in South Africa. And yesterday we had the auction of a 12.5 kilobar statue of massive gold. And you gave an amazing talk, which will also be published on YouTube.
Well, as usual, it was a fantastic event, and the way you guys organize things, there's a lot of work behind the scenes to bring people together to talk about precious metals, and it was a perfect mix of art, obviously, and the history of this beautiful piece of art, which was also a beautiful piece of history. As I said, it's not just beautiful art, it is a reflection of where gold has been over the thousands of years and where it is today and where it's headed in the next generation. It's a timeless asset, it's a timeless piece of art now, it's a perfect mix. But it was a fantastic evening, and I was happy to talk there. I was the English speaker in the room, in a room full of many, many Europeans and obviously Dutch audience, but I think we all, regardless of the language, see the language of gold, right? And I think it's fascinating to see people's interest and understanding of this metal at this time in history growing. And I think it's essential because despite all the headlines in the gold price, the global allocation to precious metals is still very small. There's still a gross misunderstanding of its role today and its necessity in the coming years. And I think any opportunity under any venue to have a chance to raise the topic of gold as sound money versus a slowly but clearly deteriorating paper money system is always important. And whether it's one person in a room, 100 persons in a room, or thousands watching, you can't understate enough how important this asset is. And I understand skepticism, having been on the buy side in a family office and having many people try to sell me things. I'm always very skeptical, and I know there's a lot of different approaches to selling or trying to convey the need of gold. But I think it's important to have a very sober understanding and to be informed and try to teach this asset to as many people as possible without coming across as a shill or just pushing or selling the book. I'm very sensitive to that, and yet I couldn't be more confident. And I'll just finish. I was in Vancouver just a few days, just in the same week, with a lot of really smart people in the gold space. And even with Ronnie Sturfula, who's an advisor to us and who's the author of the In Gold We Trust report, he knows this metal extremely well. And we were both kind of having behind the scenes conversation. This is so obvious to us, gold, and yet where could we be wrong? You've always got to be questioning when you see moves like this. It's almost too extraordinary. And yet, sadly, it's really not. So yeah, it's just so many different ways to look at this metal and this asset class at this moment in history. And last night was just another great opportunity that you guys organized brilliantly to tell the story. Yeah.
Yeah, and I think people loved it as always. You're a great speaker. I think you speak like as if you were reading a book. It's a great skill. And also, that's what I also asked you earlier on, and you just said it, is that one of the most important metric that actually testifies the trust or the loss of confidence in the system is when the bond market starts screaming,
right?
Where yields are climbing, and one of the places or most important, let's say, bond markets next to the U.S. bond market is obviously the Japanese bond market. A lot of commentators or experts in the financial industry see Japan as kind of the forefront of where this fiat system, fiat Ponzi scheme, you might even say, is heading at with its demographic slowdown and slowing down economic output and just rising yields. And the long bonds are climbing higher and higher, record highs actually. The 30-year, I think, around 3.6. It also is in the same timing as gold and price and silver price is screaming.
Right.
And I mentioned this three Six Sigma events.
Yeah.
Is this then that reset that really that purely monetary break in the shift in this regime that we're witnessing now, or are we still on the early signs?
Many good questions in that question, and I think using Japan as the canary in the coal mine, as we say, as the litmus test for what's coming, as a leading indicator, is incredibly important because there's so much to unpack there. And I think starting just backing up to post-Nikkei Japan after the crash in '89, and how Japan in many ways is very similar direction of where the U.S. is going, with the distinction that the U.S. is the home of the world reserve currency and Japan isn't. Japan is effectively a prop desk for lending around the world because traditionally, because of the quantitative easing gone mad, the money printing gone mad, they've kept yields and rates very low. And so it was an arbitrage center for the rest of the world to borrow their low rates, arbitrage, and then invest and lever in U.S. markets for S&P or even short gold and silver. That's the interesting thing. But the bottom line is Japan was QE gone wild, and its debt to GDP ratio is beyond measure and certainly higher than even the U.S. But you have to step back to that starting point, post-'89 Japan, the money printing, the yield curve control, and the yen. And it's interesting, and I can't help myself but blame it once again on a U.S. central banker, because the quantitative easing or modern monetary theory, which again is neither modern nor monetary nor theory, it's just a model, and it's a failed model, and it's failed throughout history. But the playbook that became the QE that we saw in the post-2008 era of let's just print our way out of this problem temporarily. QE was supposed to be just QE, not QE1, just QE. And Bernanke promised it would be temporary back in 2009, 2010. Of course, we had QE 1, 2, 3, 4, Operation Twist, and unlimited QE. Just another example of the fork-tongued nature of central bank policy and what they say versus what they do in the U.S. But if you go before even the QE gone wild in the U.S. post-2008, Ben Bernanke was on a plane to Tokyo with a playbook for QE post-'89. So in a lot of ways, Kuroda and all these other central bankers or prime ministers, of which they've had to rotate through constantly, that playbook for mouse-clicking your way out of a debt crisis with more debt to debase your currency began really with Bernanke, not the Bank of Japan. that was a cabal of brilliant U.S. thinkers and policymakers who kind of started that process. So that, again, we're talking decades ago. And now look at the karmic fruition and in the end game here as we come to Japan today, and as we come to boring things like rates and the JGB yield curve, right? Because Central banks can control the front end by manipulating rates up or down. It's that long end where the bond market has the real say, not a central banker, whether that's in Japan or Brussels or Washington, D.C. or the Bank of England, et cetera. That's the arrogance of central banking, and I also think it's the uncovering of the revealing of the ruse, because central bankers do a great job of trying to speak their way through crises to calm the markets, and they can technically control the Fed funds rate or the bank rate or the short end of the yield curve, but it's supply and demand, natural respect or natural fear of the issuance of bonds from a given sovereign like Japan or the US. It's supply and demand, natural price discovery that affects the long end. And what we're seeing in Japan in these sigma moves is that with so much debt and so much QE gone wild in Japan, and such pressure on its credit market, its IOUs, a lot of the Japanese bonds are bought by the citizens, unlike the U.S. The bulk of it is the Japanese savers and sovereign wealth funds or retirement plans, and this kind of very different culture and understanding and trust in their government bonds. But what we're seeing is that trust is clearly falling, because when yields are rising, that means demand for the IOU of the Bank of Japan is falling. And it's falling because they've taken money printing too far, and they've taken debt too far, and it cannot be just solved every time with creating more currency out of thin air. And that is that kind of unpredictable tipping point where you have this great idea, we can expand the credit or expand the balance sheet of a central bank, we can solve every debt crisis with more debt, and there'll be no consequences of that. That's absolutely naive. And it's kind of like that evening you're out on a date or with some friends, and that first martini or that first tequila feels really good, and the conversations get great, and everyone seems smart, and you stop there and it's a good evening. If you spend 5 or 6 hours there with 3 or 4 martinis, the tequila starts to affect the thinking, the evening starts to get kind of out of control, and by 4 in the morning you just have a hangover, and it's a bad night. And I think what you've seen in Japan post-'89, first couple of tequilas are great, first couple of margaritas are fun, it's time to look at your watch, go home and have a good night's sleep. What Japan has done is just stay out all night. And now the hangover is coming, and you're seeing that at the end of the yield curve in these long-term bonds. And we're going to see the same thing in the U.S. The U.S. debt to GDP isn't as severe as Japan, but its bond market is under stress because the level of debt is so much higher. But as the home of the world reserve currency for decades, the U.S. could export that inflation, or they could get demand for the dollar through the petrodollar system or through the derivative system or the euro-dollar markets. There was this huge straw-sucking sound, as Brent Johnson said, this huge sponge for demand for our exported currency or IOUs. Petrodollar is a massive source of demand, for example. Japan didn't have all that. Instead, it kind of just became, as I said, the prop desk. Keep monies flowing in, because Japan was being used as the center for leverage around the world in other markets and other currencies. There was one big currency and interest rate swap in Tokyo. And anyone trading the markets would know that. And for years, when things are going great, it was a system that worked. Just like when you're having 1 or 2 martinis, it's a system that works. Those margaritas work until you go too far, until there's a tipping point. And for the average citizen on the street who isn't arbitraging currencies, rates, and swaps across international markets, who would know, or who would even read that article, and that they just pass that article by? For those of us in the markets, or looking at the macros, or looking at the flows, what's happening in Japan is a very significant moment. And so if you're running out of liquidity or inexpensive liquidity, low rate liquidity, and since the entire global system works on liquidity, it's the oil in the engine. If liquidity, cash flow, tightens, the system starts to cough and choke. When the system starts to cough and choke, you start seeing breakdowns in risk assets, certainly in credit and equity markets, and then you start seeing a gradual rotation into hard assets and a gradual rotation out of paper money trust. Again, they're all connected, but it really comes down to debt gone wild, fantasy gone wild, this notion that a central bank can save you by literally fabricating money out of thin air without inflation or without taking debt so far that eventually trust in that debt declines, and the reissuance of JGBs or US Treasuries or German bonds becomes less effective, where that last martini is no longer making you happy, it's making you sick. And I think we're at that point. None of us can predict what the next signal will be or when the final, I hate to say it, puking sound starts, when markets really start to puke, but we are getting so close to that embarrassing walk of shame home from the bar with this incredible overuse of fake liquidity, credit expansion, currency debasement, and debt that's unsustainable.
I've also seen, I think it was this common graph that you see of the Weimar time, where the price of the mark, the back then Reichsmark was just going parabolic, and then in that phase as well, there was a price of gold that also zigzagged. And this was characterized by high volatility and also the price of gold. Do you expect as well that if, let's say, we are entering this inevitable QE type of era and regime, that we will actually then see this resurgence of inflation and thereby maybe mimicking what we've seen then in the Weimar era?
Yeah, it's fascinating. Again, the more things change, the more they stay the same. These cycles of desperation. What are the options left? Whoever's in the Fed, it could be Tweedledum or Tweedledee. It could be. It's going to have to be a dovish Tweedledum or a dovish Tweedledee. We can argue about whether the Fed is independent or dependent, whether it's a fourth branch of government, whether it's a cabal. It's many things. It's neither federal nor a reserve. And as I've said many times, it's not even constitutional, but I'm almost amused by the Fed and the Fed debate. But kind of tying this all together, Weimar, of course, is an extraordinary example. But, when you debase the currency at such a level, the rise and fall of gold during that period of belief and faith and trust, because during the Weimar there'd be headlines, we've just reached an agreement, Versailles being modified, things are good, and then gold would go down again. It would last for a week, a month, because it was really more words, not truth. And we are in a secular bull market, absolutely, for gold, and we'll talk about why. And it's not just like a NVIDIA trade or a tech stock in the 90s. This is a much more dangerous bull market, what it signifies. But of course, be very clear, no bull market, in particular with gold, is without volatility and without price swings. But the long-term direction, to me, that's what Ronnie and I were talking about, is just so obvious now. Augenscheinlich klar, we'd say, it's just so obvious. And yet, where could we be wrong? And what we're seeing now with the gold price going from 2,600 last time we spoke in South Africa together to today, it's extraordinary. It's extraordinary even for someone who understands this market, the slope and speed of it. But do not think for one second that or any of us in this space have the hubris to think that this is now never going to end. There will be retracements. If you understand gold, that won't bother you, but there will be. The traders will get shaken out. But, tying that kind of Weimar example to now what the Fed will do, just like what could the Reichsbank do? What could happen during Weimar? Is America in 2026 Weimar Germany? No, because we're still home of the world reserve currency. There's still this massive power in the FX swaps of the US dollar. There's still this demand for our disturbingly weird bond market. But that doesn't mean we're not going to have a Weimar-like ending at some point. Not the end of the dollar or hyperinflation to that level, but we're going to see a shift. And I think whoever comes into the Fed's chair, the new sheriff in town at the Fed, there is really no option but to be dovish. You can't fight inflation with rising rates, because if the rates on the 10-year goes above 5%, we've seen over and over that the U.S. stock market and the bond market can't handle that. They just can't. They literally can't stomach that. We've seen that over and over. And it's always required more grease, more engine oil, more liquidity, whether that was direct QE, whether it was taken from the Treasury General account, whether it was issuing bonds from the short end of the curve, or whether it was the reverse repo and repo markets providing liquidity. Whenever the rates got to a certain point, everything started to cough smoke and pull off the road. The plane came off, peeled off towards the ground. In other words, we don't have a tool to raise rates to fight inflation. At $38 trillion in debt, we can't be Paul Volcker, or any central bank can't raise rates to fight inflation without absolutely destroying everything but the dollar and leaving a trail of destruction. So what will the new Fed sheriff in town do, just like they'll try to do, is try to use a thermostat to control inflation and have rates somewhere at the optimal level and print just enough. That is not a thermostat. It's, as Luke Groman said, it's a switch now. It's either risk on or risk off. It's a long way of saying governments will have to decide between saving their currency or saving their bond market. It's that simple. It's that binary. And since governments, especially the US, which exported the American dream to China decades ago, since it doesn't live on manufacturing, it lives on debt, it will save its bond market. It'll go dovish. It'll have to control yields, to print money, to buy unloved US treasuries. And that net result of that is the currency will suffer, because when you monetize debt by expanding the Fed's balance sheet and expanding credit and expanding M2 supply, they're all connected, you debase the dollar. That's where it's Weimar-like. It's not as severe as Weimar, because Weimar was a post-World War I, they lost, they had reparations, and they weren't the home of the world reserve currency. So the US has more power to extend and pretend than Weimar did. We've been in a slow Weimar since 71. Now it's starting to happen. But, to your point, the next Fed sheriff in town will have to be dovish, because there is no option to be hawkish. And Powell tried higher for longer a couple times in 2018 and 2022 to 2028. This is a disaster. Worst stock and bond returns anomaly since 1870. So he knows that was a facade. And whoever comes in next, under the pressure of Trump or whoever there to be dovish, sure, be dovish. You can save anything with a money printer, but you'll kill the currency slowly but surely. And that's why gold is rising so fast right now. Those in the know, those who watch the bond market, which is everything, see the end game. Not with certainty, but it's fairly clear. And I was listening to Grant Williams. None of us should say with certain. Anyone with headphones on, he said, don't just take our word for it. But anyone I speak to in credit markets who's kind of watching this has the same view in terms of the probabilities and the inevitabilities. There's always a black swan event. There's always something we can't predict. There's always the unknown forces and time delays in markets. But the bottom line is governments are broke. They need to mouse click more liquidity, and that will be at the expense of the currency. And because it's a debasement trade, gold is rising, and alongside of that, silver is too. So these are all connected things, and they're not terribly surprising. So how much harder will these systems try to fight to try to be everything to everyone is something for all of us to kind of guess. We can't time it, but we can see the direction of the ball very clearly right now.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at Gold Republic. At Gold Republic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, security saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults, with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at Gold Republic, we offer real assets to safeguard your generational wealth. And so, might sound like a naive question, but the fact that both gold and silver move together, when in history did this happen to those intensity, those extremities? And obviously it has to do also with the way the paper market is structured, and we've also had conversations about this. But since the demand as well of silver is not the same as it is in gold, for silver, for the most cases, it's industrial, and now there's a narrative around the fact that we need it for AI, for batteries, catalyzers, motors, electrification of everything, green agenda, electric vehicles, you name it. How do you dissociate it? Or is it just about market mechanisms and then the narrative? Where do you see the difference?
Well, there are so many things that are consistent about gold and silver, but silver, whether we were having this conversation 5 years ago or right now, there's still the same duality. Silver is much more kind of bipolar. It has monetary values. It's a monetary metal, but it's also clearly an industrial metal, and the industrial demand is getting higher for AI power centers, Samsung phones, solar panels, nuclear, et cetera. It's even been listed last year as a national interest mineral of national security for the military and for tech. So the industrial side of silver, the narrative has gotten stronger, of course, which would explain why the recent attempts since December to fix the price in silver markets by raising margins failed, because whenever the COMEX tried to push the price down, industrial demand took that as a sign it's on sale, let's buy it and go long. So they failed to manipulate the silver price because of the industrial demand. When you add to that changing industrial demand and a higher tech new normal, with the monetary properties of silver as well, and the relatively small market cap of the silver market, it doesn't take much demand to push that price up dramatically. I mean, a year ago, silver's global market cap was half of NVIDIA's market cap. So any increase in demand, whether it's retail or industrial or just momentum, is going to have a massive price move, right? So both the monetary and the industrial kind of profiles of silver have fallen into a very interesting trend right now. If you look at technicals, those also, I'm not a trader, but if you look at the technicals, when you see breakthroughs of the gold-silver ratio, which we saw in 1979, 1980, and again in 2010, 2011, well, we just saw that in November of 2025. And that gold-silver ratio range, when silver breaks out, like it did recently, it tends to have a radical move north. And we have those technicals that are kind of clearly confirming a bull market in silver. We have these industrial and monetary properties also as tailwinds. So it really is an interesting time, obviously, for silver. It went to 50, 60, 70, 80, 90, 100. It's extraordinary. Does that mean silver only goes up and to the right? No. It can, as Egon has said so many times, silver is not for widows and orphans. Because of those kind of dual properties, it can be very volatile. And even with the COMEX having less control over its manipulation, it can still break hearts. But that said, if you look at the technicals and you look at the market cap and you look at the demand, free price discovery in silver should see silver easily at 200 to 300. And if you can look at some charts, and I'm not saying this, but if you looked at M2 money supply to silver circa 1980, that would put silver at $800 or $900 in comparable terms, or inflation-adjusted terms, $250 should be the floor. Does that mean I'm predicting $900 silver? No. Be very clear, I'm not predicting $900 silver, certainly not this year. I'm saying you can make the case for radical moves in silver. If you're thinking, though, of silver as a monetary metal that will be safe and sound and a better store of value than gold, that's a different discussion, because I don't think it is. We've never recommended for wealth preservation or sound money that you have silver as the solution. I think what silver outperforms gold in these bull markets in the precious metals, you take the gains in silver, you pick your exit through gold-silver ratios, not through fiat price, and then you take those winnings and you reinvest in gold. Now, others who are much more complex and sophisticated, like Rick Rule, will take those earnings and reinvest in miners. That's if you have more risk. It's not for me to tell. But silver is a very different monetary metal than gold. Gold really is the grandfather, the mama metal, the juggernaut. And silver is that little speedboat that outperforms in bull markets, but can also take you down into the moments of despair if you're not watching it carefully and you haven't picked what your return is. It's an impossible answer to give to every investor. If you bought silver at 5 and it's over 100, is that good? Are you not entertained, as Gladiator would say? That's a personal choice. You may say that's great, but I think it's going to 200 or 300. That's not an irrational argument to make. But again, where do you get out? Where do you think enough is enough? Where is that gold-silver ratio? The signal to move. Egon has a view it's at 11 or 15. Historically, that's confirmed. But others may be more cautious, and they may be looking for 40 to 30 ratios. We weren't that far long ago. It was a 100 ratio. So things are happening so fast. You have to look at these signals very carefully. You have to look at your own profile, know thyself very carefully. What is a good enough return? If you think you can predict the price and the top, you're probably wrong. You have to be humble. And yet, at the same time, there's no doubt there's so much data that proves that silver can go much higher. And the problem is when you work in an industry where I sell gold and silver, it's very easy for the audience to say, well, he's always going to be bullish. He's always going to say buy. And that's not how I look at it. It's much more nuanced than that.
You've also, that's how actually we started the conversation, but you've alluded to the fact that we're in a Stalingrad moment, that the fact that if we look at the geopolitical landscape a little bit more, we have still an ongoing war in Ukraine that is also entering its fifth year or fourth year, I think. We have, still tensions in the Middle East. We have the ongoing protests in Iran. There's also the Gaza situation that is still not settled. China is also making moves, and there's guesses about, if they will actually take over Taiwan by 2030, who knows? And then there's the ongoing, bloc war. There's a European bloc, there's let's say the Eastern bloc, the BRICS bloc, and there's the Western bloc that is just like the US kind of trying to dictate its own rules to the rest of the world. And as you mentioned, being kind of stuck in a dilemma between being either country or an empire.
Right.
How do you see this as well, as especially like since you're also here in Europe and you became European in a residency maybe manner. Your family is also like half French. How do you see this like unfold also for Europe, like to be basically squeezed between those two giants, and where we in Europe, we always make the joke we're great at regulating, like it's a meme of in the US they have SpaceX, and in Europe we have bottle caps attached to
That's true.
caps attached on the bottles. How do you interpret that as a French resident?
Yeah, no, look, these are questions that we've spent hours on because it's such a fascinating difference between Europe and the U.S. There are strengths and weaknesses. There are different vulnerabilities. There are very different mindsets. I mean, that's just an extraordinary conversation and topic. I, for one, will never say I will predict what will happen in Taiwan, Greenland, South America, or U.S. foreign policy. No one knows exactly what could happen in the Ukraine. No one knows exactly what could happen in Iran. We certainly can see the tides and the tensions. But I think rather than trying, and I'm no geopolitician, I'm certainly no former State Department employee, and I'm not a military expert. And I can't get into the psychological nuances of Trump's mind or anyone else's mind. But I think we can all agree that there is rising tension and stressors and weak points and Achilles heels in foreign and monetary policy. And I think stepping back with your larger question about Europe and where its place is in the US and where it's headed in the world with all its tensions, the first thing that comes to my mind, is Henry Kissinger. I'm not a big fan of him, but he was a genius. He was a very clever genius. And he famously said, to be an enemy of America is dangerous, but to be a friend is fatal. In other words, be careful who you get engaged with. That was a very blunt admission by Henry Kissinger, a major figure in U.S. foreign policy. I think what he was kind of suggesting is we really are only out for our own interests, which is an honest confession. I mean, even George Washington said, we have no permanent friends or enemies, we just have permanent interests. Very Machiavellian, you could say. Now, if that's true, look at what happened in the Ukraine war as just an example. I mean, we could go on and on about how that was such a clearly avoidable war. Jeffrey Sachs made that very clear to me years ago. That was Douglas McGregor, a colonel, John Mearsheimer, an academic, Jeffrey Sachs. It was very clear that was an avoidable war, that we have a lot of our fingerprints on that crime. That could be highly debatable, but I won't get into that. Regardless, it's very clear that we got the West, the coalition of the willing, like we did post 9/11, we got the West in general and Europe in particular to follow our lead in slapping the wrists of the bad guy Putin without having any understanding of the Crimea and the history and all that. We just, Putin bad, Zelensky good, sanctions, shut that down. Well, that has a moral kind of dopamine rush in 2022, but then within months, Germany's burning coal instead of getting natural gas, as an example. Inflation's rising, Volkswagen plants are stressing, layoffs and recessionary forces are happening. Germany following the U.S. lead was not a good thing. I don't think England following the U.S. lead into Iraq was a good thing for England, and certainly not for its soldiers, many of whom I've seen handicapped in Invictus games trying to play sports with no body parts. So, I mean, it's a very serious thing to follow the U.S.'s policy. Am I a diplomat? No. Do I have a right to say who's right or wrong? No. I've always said soldiers, whether they're U.S., American, or elsewhere, are lions being led by donkeys, following policies that are more financial rather than moral. Most of America's wars since Iraq have been financial, not moral. That's a very sensational statement. But in terms of economics, has it really helped Europe to be the dog wagged by the tail of U.S. policy? My opinion as a European, or as an American living in Europe for decades, and as an American who loves America, is patriotic, who's critical of America because I love that country, I don't think American foreign policy is for the best of Europe. I don't think American monetary policy is for the best of Europe. And as an American living in Europe, I see that evidence of that everywhere. I see the cynicism against U.S. policy and U.S. monetary policy and foreign policy rising. Now, you and I talked about, since the Kennedy era, American faith in government was at 80%. Today it's less than 20. That's not just a Trump effect. That's many years of building distrust. So this isn't just Europeans mocking American arrogance. Even Americans are losing trust in American policy, from the Fed to the White House. Obviously, Europeans too are caught between these forces. Does it mean I'm pro-China or pro-Russia? No, I've always said I don't want to live in Shanghai or St. Petersburg. But Europe is at a point, and you and I are going to have no influence on this, but Europe's at a point where they're between two flows of history. Russia and China have many problems, but there's clearly trade advantages going east, not west. It would certainly have benefited Germany and other European countries to be neutral or at least realistic about Russian energy for what was good for Europe. But because they're always under the surveillance of their American mother and father, so to speak, always having that chaperone there to slap them down, I think they made the wrong choices. If I were at the ECB, I would print as many euros as I can and start buying physical gold, because I would not want the US dollar and US Treasury dictating my policy. I would want to have independent decisions vis-a-vis China, Russia, and America. This goes to, are we going to cooperate or are we going to pick a camp and fight? And John Nash, equilibrium theory from the Beautiful Mind, we'd be better off cooperating rather than trying to fight. And Trump's in a schizophrenic moment right now. Make America great again, focus on America, or make it an empire and be in Greenland and Venezuela. You can't have both. You have to choose, in my opinion. And we're just losing credibility. But he is acting like a cornered animal rather than a wise diplomat, because cornered animals are desperate. And you can understand the reasoning why he'd be in Venezuela or why he'd be in Iraq or regime change in Iran. We need energy solutions. We have to now bully our way into these problems because we're so broke at home. Long nuances to each of these topics, but we're at a moment where trust is failing, desperation is rising, and policy is getting more precarious. And central bankers have very little choices but to either print or surrender. And in the meantime, as all this is breaking down after decades of that one too many martini, Russia has much less debt than the US, and China is growing massively in its trade relationships. And its gold is not going to be a new currency, but the currencies of the world are revolving around gold for net settlement and balance of payment trades. That's not a statement of sensationalism, it's a fact. Gold is changing. Even the IMF has gold as part of its kind of new world order. So gold is becoming more central in these plays. The dollar is becoming less central. Mathematically, gold is the new FX reserve. Gold is the new central. I mean, it literally is the strategic reserve asset. Not just me saying that. The BIS has said it, and the BRICS are doing it that way. And certainly soon, I think Europe will have to do the same. How this unfolds, how smooth this unfolds, I don't know. And yes, I'm a gold expert, but gold will play a role in the new abnormal of coming out of this debt crisis, whatever this reset is going to be. Wilhelm Mittelcooper, he wrote the big reset. Is it going to be cooperative? Is it going to be conflict? He doesn't know. I don't know. But gold plays a role. And I'm not saying that because I'm selling gold pet rocks. I'm just saying that almost more as an historian, an economist, and this kind of blender. The direction of this hockey puck is so clear to me. Does that mean gold only goes up to the right? No. But all these things are connected. Sigma moves in the bond market, the JGB trade, U.S. foreign policy, the harder to quantify issue of trust, the disastrous foreign policy and monetary policies of decades, which worked for a while, and now the hangover period. It's all connected. But among all this noise and fog is gold, which is far more honest than central bankers or foreign policy makers. And it's rearing its head and rising in value. And the price of gold isn't what should shock us, because what it really is signifying is trust in U.S. paper money and the world reserve currency and paper systems in general. That's the real shock. It's not gold at 5,000. It's the level of distrust for the paper money system, which was great for a while, but now it's been one too many margaritas. And we're heading into that very unpleasant, sickening feeling.
I was also thinking about the fact that in those periods of stress that governments, because of their desperate nature, would do erratic things, just like confiscations, for example. So that if there's this escape hatch that is being too crowded, that actually shows that the government is not able to keep its currency in the light that is, still in confidence, there might be a moment where we see this happening not just in the US, but in pretty much any country in the world that is crawling under debt, where the appreciation of gold will be so stark, and you've kept on saying this in your talk as well yesterday. If there's one thing that bankers and central bankers don't want to talk about, it's gold.
Right.
That they will be forced in one way or another to confiscate the gold and maybe start some form of revaluation or a reset, but on their terms and disowning the people who actually protected themselves.
Well, I mean, Greenland's a classic metaphor example. If you don't hold it, you don't own it. It's either yours or not. And with physical gold, analog gold, we've always said in Von Greyer's that you've got to own it outside of the system. You've got to be able to touch it, feel it, assay it, and trade it. But it's got to be yours. In terms of what could happen with desperate governments and revaluation, I think we're already seeing that in a sense. I mean, the Fed manual for Federal Reserve banks came out last summer. They're already talking about a potential revaluation of the gold Uncle Sam already has on the books at $42 an ounce. If we revalue gold at current prices, that would be a significant amount of money that we could use to pay down debt. But if we let gold go to 20,000, let it run or reprice it, that gives us $5 trillion in liquidity. That gives us a lot of time to restructure our debt. So there would be a tactical and strategic reason to revalue gold to 20,000. That may seem extraordinary. Again, I'm not saying gold's going to 20,000. That's an entirely reasonable solution.
That's only 4 times.
It's only 4 times current price. And frankly, based just on technicals, we're only halfway through a typical 8x move from trough to peak in gold, technically speaking. And then if you look at all the fundamentals in the trade and the BRICS and the de-dollarization, central bank gold stacking, gold at 8,000, 10,000 is really not a stretch. It's amazing to me that Bitcoin can go from 0 to 100,000 in 16 years and no one's bothered. But if gold goes to 8,000 or 10,000, I think that's extraordinary. When in fact it's just the opposite.
It's the same market cap though.
Yeah, some say that. But again, there is a tactical reason to revalue gold. I call that the red button option. But the Fed's already kind of suggesting that. It's what I would do. I wouldn't do it at 5,000. I'd wait for gold to be at 10,000 or higher because you'll get more out. Let gold run. It's actually a national interest to let gold run. Or you could more drastically simply revalue gold at price 20K. And then, of course, you create a new floor. And then there's Kissinger's warning, well, if you do that and you create a new floor in gold, who has the most? That's the question. Does China or Russia have what the World Gold Council says, or does it have more than the U.S.? I don't know. We never got that audit. And again, there's a lot of things we never got that were promised that just kind of fell out of the headlines. Talk about trust. And again, this is neither pro nor anti-Trump, but we were supposed to end the Ukraine war in 24 hours. We were supposed to have an audit on our gold. And we were supposed to have the Epstein list as just an example. None of those things have happened. We were supposed to avoid foreign wars. We've been bombing Iran, and now we're looking at, Navy SEAL or Delta projects in Venezuela. Are we what we need to be doing right now? But I think the hidden agenda at the Fed and at the Treasury is they have this secret weapon. They could revalue gold. That would buy a lot of time. In the meantime, central banks are stacking gold for a reason. This isn't just a fear trade. This is a strategic move that is keep gold as low as possible, as long as possible, so they can stack it before it gets revalued. Even the IMF sees gold as a central coverage ratio in its central bank digital currency moves. So gold is the future here. I don't know the price. I'm not trying to sell it. I'm just saying, look at what's happening on the ground. Do I know for certain? No, but the probabilities and the indications and the evidence is everywhere. The gun is smoking, so to speak. And the reason these parties, these major parties, this isn't even retail buying, it's central bank buying, is driving the gold price. The reason they're doing it is very simple. I keep saying they build the ark before the rain. They load their guns before combat. They're getting their gold before this reset, this revaluation trade, because gold is the debasement trade. Gold is the new global strategic reserve asset. It is not the U.S. Treasury. That genie's never going back in the bottle after we weaponized it in 2022. Never. It's never going to be trusted again. That was a watershed moment. And so these are all things people have to look at beyond just the daily gold price, which is mir völlig egal. I don't look at it. I literally don't look at the daily gold price. It doesn't surprise me at all to see it at this height. It doesn't surprise Egon. It doesn't surprise any of us. We're shocked by the speed of it, but we're not surprised, and there's a difference. And this is not a bubble, it is a bull market. It is a symptom of a dying paper market. And that is what people need to try and put their arms around. And again, don't take my word for it. Do your own homework. You'll see the history of paper money since 71. You'll see the history of what gold does as systems die. As Thomas Gresham said in the 1500s, eventually when you have two currency or two money forms, bad money, which is paper, and good money, which is gold, eventually as the debt gets higher, you'll see a rotation from bad money to good money. This was hundreds of years ago. David Hume said the same thing. Adolphe Thiers said the same thing in France. We're just seeing that right now. The move from bad money to good. And that's happening at the BRICS, at the central banks, and probably at the US Fed. They're going to probably revalue gold at some point to a much higher level and let it run until then. So that's the debasement trade after too many martinis. Once again, it's all tied together. And gold is always there somewhere. And we're seeing huge price moves because we're seeing a massive shift in the global financial system and the paper money system. That, to me, is fairly obvious right now. And where it goes in the next 10 years in price terms, don't listen to anyone who can predict it. I just see it meaningfully higher. That's what I see.
Great. On this note, Matt, thanks a lot for this yet amazing conversation. I mean, it's always a treat. I keep on saying this every time I see you, but it's true.
Oh, well, it's
one of my favorite people to talk to.
Well, thank you.
Well, thank you. And obviously, those who still don't know Matt, which I think is kind of a lie or not the case, you also have a Substack where you also publish a few articles once a week.
Through Von Greyer's Gold.
Exactly, yeah. So people can find you there, and maybe one day you have a Twitter account, your own Twitter account, but I don't think so.
I don't think, I don't even have a Facebook. I want to stay home with my dog, I think, and the kids, so.
And play photo.
Yeah, exactly.
Great,
Yeah.
thanks a lot, Matt.
Thank you, Alexei. It was always a pleasure.